BigBear.ai versus C3.ai. Which AI stock is the smarter buy? What investors need to know. Are you ready to dive into the hot world of AI stocks? Today, we're pitting BigBear.ai against C3.ai to determine which company is the smarter long-term investment in the booming artificial intelligence market. With innovation skyrocketing and AI shaping industries like never before, this is one battle you won't want to miss. In today's video, we're going to explore BigBear.ai and C3.ai, two prominent players in the AI space with very different strategies and strengths. Welcome to the Finance Savvy. If you enjoy in-depth analysis and insights into the most exciting investment opportunities, don't forget to hit that subscribe button and give this video a like. If you have questions, feel free to drop them in the comments or reach out. We're here to help. BigBear.ai versus C3.ai, the showdown. AI has taken the world by storm, and investors are eager to ride the wave. BigBear.ai and C3.ai are two companies making headlines, but they couldn't be more different in their approaches and financial performance. Let's break it down. C3.ai. Strength in partnerships and growth. C3.ai has carved out a strong position in the AI market by delivering turnkey AI applications to a wide variety of industries, from energy to manufacturing. Its success is built on a powerful partner network with major players like Microsoft and Google Cloud. These partnerships are critical, with 62% of its deals in the second fiscal quarter of 2025 coming from this network. Financially, C3.ai is showing strong momentum. In Q2 2025, it posted $94.3 million in revenue, a 29% year-over-year increase, with 86% of that coming from recurring subscriptions. Recurring revenue is a gold mine for any tech company. It provides stability and predictability, something investors love. But here's the catch. C3.ai isn't profitable. It reported a net loss of $66 million in Q2 2025, though that's slightly better than its $70 million loss a year earlier. With a strong cash reserve of over $730 million, the company has the resources to keep investing in growth. However, all eyes are on its key partnership with energy giant Baker Hughes, which is set to expire in April 2025. Baker Hughes reportedly accounts for a third of C3.ai's sales, so its renewal, or lack thereof, could significantly impact the company's future. BigBear.ai, AI for national security. BigBear.ai takes a different approach, focusing on AI solutions for defense and national security. From analyzing images of travelers at airports to supporting military operations, its applications have a niche but vital market. Clients like the U.S. Air Force, Army, and Navy rely on its technology, and its recent acquisition of PangIam has expanded its capabilities. However, BigBear.ai's financial performance is less inspiring. While its Q3 2024 revenue grew 22% year-over-year to $41.5 million, much of that growth came from acquisitions rather than organic expansion. In fact, its total revenue for the first 3 quarters of 2024 was flat compared to 2023, raising concerns about its ability to sustain long-term growth. Profitability is another issue. BigBear.ai's gross margin in Q3 was just 26%, compared to C3.ai's robust 61%. With a net loss of $12.2 million for the quarter and inconsistent sales growth, BigBear.ai faces significant challenges. There is, however, a glimmer of hope. The company recently brought on Kevin McAleenan as CEO. A former acting Secretary of Homeland Security, McAleenan's leadership and connections could open doors for new government contracts, especially with a potential shift in the political landscape. Who's the better buy? Both companies are intriguing, but they come with risks. C3.ai stands out for its steady revenue growth and strong partnerships, but the uncertainty surrounding its Baker Hughes relationship is a major red flag. Meanwhile, BigBear.ai's focus on national security is compelling, but its inconsistent growth and weak margins make it a riskier bet. At this point, C3.ai appears to be the better AI stock thanks to its larger market presence and stronger financials. However, with both companies still unprofitable, this isn't a slam dunk decision. Investors should monitor key developments, like BigBear.ai's Q4 performance under its new CEO and whether C3.ai secures a renewal with Baker Hughes. What's next? As we wrap up, keep an eye on the broader AI market. The sector is evolving rapidly, and opportunities are everywhere. In our next video, we'll take a closer look at supermicrocomputer, SMCI, a rising star in AI hardware solutions that's starting to gain serious momentum. Don't miss it. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Savvy for more in-depth insights and analysis on the hottest investment opportunities. Have questions or thoughts? Drop them in the comments below. We'd love to hear from you. See you in a few seconds. Happy investing. BigBear.ai versus C3.ai recap plus supermicrocomputer. The hidden AI gem with 330% potential upside. Artificial intelligence is revolutionizing the tech world, and the investment opportunities just keep getting better. In our last video, we pitted BigBear.ai against C3.ai to determine which AI stock stood out as the better buy. Now, we're taking the next step into the AI ecosystem by diving into supermicrocomputer, SMCI, a company with the potential to skyrocket by a staggering 330%. Is this the underdog AI stock you've been waiting for? Let's find out. Welcome back to the Finance Savvy. If you love in-depth analysis of the hottest investment opportunities and tech trends, don't forget to hit that subscribe button and turn on notifications. Today, we're exploring whether supermicrocomputer is the ultimate buy-the-dip opportunity in the booming AI market. If you have any questions, feel free to drop them in the comments. We'd love to chat. Now, let's dive into the video. Recap: BigBear.ai versus C3.ai. Before we get into supermicrocomputer, a quick recap. In our last video, we compared BigBear.ai, a niche AI player focused on national security, with C3.ai, a turnkey AI solutions provider working with giants like Microsoft and Google. Both stocks showed promise, but each came with risks, especially as neither company is profitable. C3.ai stood out for its solid partner network and steady revenue growth, though it faces challenges like the possible expiration of a major contract with Baker Hughes. Meanwhile, BigBear.ai showed promise under its new leadership, but struggled with inconsistent sales growth and weak margins. If you haven't watched that video yet, make sure to check it out. It's a must-watch for anyone following the AI market. Now, let's shift gears and talk about the next player in this space, supermicrocomputer. Supermicrocomputer, a quick overview. Supermicrocomputer, NASDAQ, SMCI, is a leading provider of AI server products. While companies like Nvidia grab the headlines for their GPUs, SMCI is the unsung hero, delivering the hardware infrastructure that powers AI applications. This includes rack-scale systems optimized for cutting-edge AI workloads. Now, here's the twist. SMCI stock has been a roller coaster. Since its peak during the AI rally in 2024, the stock is down a whopping 72%. But recently, it's been showing signs of recovery. So, is this the perfect buy-the-dip opportunity? Let's break it down. Why SMCI stock dropped. SMCI's decline started back in March 2024, triggered by slowing growth and missed revenue and margin targets. Things worsened when the company faced accounting allegations by Hindenburg Research in August 2024, which caused a 20% single-day drop and led to a Department of Justice investigation. To make matters worse, SMCI's auditor, Ernst & Young, resigned in October 2024, further fueling uncertainty. The company also risked NASDAQ delisting after failing to file its 10K and 10Q reports on time. With all this drama, it's no surprise that SMCI became a risky investment. But here's the exciting part. Things are starting to turn around. Is SMCI making a comeback? Despite its challenges, SMCI is leveraging the growing demand for AI infrastructure. The launch of Nvidia's Blackwell-powered rack-scale solutions in February 2025 has given the company a much-needed boost. Analysts are now forecasting 70% revenue growth for SMCI in FY 2025, driven by the exploding demand for AI servers. The company also made a critical move in December 2024 by hiring BDO as its new auditor, addressing concerns about its accounting practices. While it still faces the risk of delisting, SMCI has until February 25, 2025 to file its delayed reports and comply with NASDAQ requirements. If SMCI pulls this off, the stock could surge significantly. Analysts are optimistic, with some setting a price target as high as $135, representing a staggering 330% upside. Even the average price target, though more conservative, suggests 14.5% downside, leaving room for debate on whether it's worth the risk. What makes SMCI a strong contender? Let's talk about the fundamentals. SMCI is significantly cheaper than most AI stocks, trading at just 10.5x forward earnings and 0.7x forward sales. Compare that to the sky-high valuations of companies like Nvidia or C3.ai, and SMCI starts to look like a bargain. But it's not just about being cheap, it's about growth. With projected 64% sales growth in FY 2025 and 25.8% EPS growth, SMCI is positioned to capitalize on the AI boom. Should you buy the dip? Here's where it gets interesting. While SMCI's delayed filings and delisting risks are concerns, the company's fundamentals and growth potential make it a compelling gamble for investors with a high risk tolerance. The upcoming business update on February 11th, 2025 could be a turning point. If management provides clarity on its financials and roadmap, it could restore investor confidence and trigger a rally. In my opinion, SMCI is a high-risk, high-reward play. If you're willing to ride out the volatility, this could be an opportunity to buy into the AI infrastructure boom at a discount. The bigger picture, AI stocks to watch. As we wrap up, it's clear that the AI market is full of opportunities, but also risks. From BigBear.ai to C3.ai and now Supermicrocomputer, each company has its strengths and weaknesses. The key is to stay informed and think long-term. In our next video, we'll be diving into even more exciting AI opportunities, including a closer look at Nvidia's latest advancements and how they could impact the entire AI ecosystem. So, stay tuned. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Savvy for more in-depth insights on the hottest investment trends. Got questions or comments? Feel free to reach out. We'd love to hear from you. Until next time, happy investing